This video will guide you through how VisionWorks, our next-generation life planning software, can take your financial planning business to the highest level.
Thank you for your time. What we'll do today is we'll call this Learning and Decision-Making Part 1. And it's really a prelude to what we're going to be talking about over the next several weeks, which is creating plans for clients and plans that are truly effective and that they embrace and want to implement. And the first thing I want to talk about relative to what we'll discuss is that the emphasis in the industry has been on the written plan. And if we look back 30 years or so, technology was relatively crude. Plans were being built predominantly by spreadsheets, supplemented with tax software. So advisors would work away, use a variety of tools and then assemble everything into a nice presentable format. High quality paper, leather binder, let's sit down and go through the plan. And in many regards, that still is going on today, even though we're talking, literally 30 years later. And the reason for it is because a lot of the planning software that exists is actually pretty inaccurate. So examples that come to mind for me, at least, are things like rental properties. When planning software doesn't do them correctly, or businesses or whatever it might be, then advisors end up building side spreadsheets and they have to start manipulating those, and then they have to start editing the output of a plan and so on and so on. So in many ways, we're still operating with outdated technology, and it's because of that the emphasis is on doing a written plan for people. The problem is written plans aren't really very effective. And there are a number of reasons for that. And I want to go through them today because this is all really the foundation for saying, let's leave this old technology behind. It's not effective. Let's embrace a much more modern approach, which is, of course, creating plans interactively with clients. And in the process, not only will we create plans that suit clients and that they embrace, but we're actually going to save a lot of time. And I think that's a very key factor in today's world. What I see is a lot of advisors opting for very simple planning tools because the traditional tools just take too much time. And the issue, obviously, is because of time problems, we're cutting down the quality of plans, and we're cutting them down to the point where a lot of the output that's being generated for clients is actually quite incorrect and very misleading. So if we want to do plans that are not only effective, but also accurate and do them in a timely way, then we have to start embracing interactive planning. So the first thing I want to talk about is, what is the whole point of a written plan? Well, we're creating a plan for the client. So the plan really is a proof statement for people. If you stay on the path you're on, this is the outcome that we predict. And if you make these changes, this is the revised, the enhanced outcome we predict. So let me explain all of that to you to encourage you to accept the recommendation. So we prove our recommendations, and proof statements, plans that, give you the before and after, explain why the change, give you the projected results after the change. They just take a long time to do. The other problem with them is that as adults, we really don't learn particularly effectively by having something explained. In fact, if you look at brain activity, and I'm speaking of the conscious mind now, I'm not talking about brain activity that's involved with, heart rate and things like that. But of our conscious mind, about 80 to 85% is actually visual. And only about 5% is through our ears and so on. So when we end up sitting down and working through a plan with people, well, we're looking at numbers, but they're just numbers on a page and somebody's explaining things. It's not a very impactful way of learning. And so there's a better way, which is to, of course, work more experientially with people. And I'm just going to bring up VisionWorks, and you're all aware of the approach that I always like to use with, for example, vacations, where I take an entry and change it over time, where if I bring up the income assets, you're going to have a lot of income assets. Oh, does that mean we can spend more on vacations in our retirement? We make some adjustment for clients, resave, and immediately clients see the before and after impact. And that is far more impactful for them than reading something in a report. So I want to take the same approach, and I'm just going to go over to taxes and the tax optimization. Now, in this plan, we're not going to see a big difference in the optimization, just because I'm fairly politically correct when it comes to the assets that Bill and Sue have and so on. But all we need to do is click the optimize button. The software goes through, switches donation and medical credits every year of the plan to whomever will get the greatest benefit, shares CPP if it's appropriate, and also splits pension income every year of the plan, depending on the most effective split, and tells us that the taxes saved will be $4,600. This is up to Bill's life expectancy. The OAS clawback will be reduced by $1,200, so there's an overall benefit of $5,900, and then the whole plan difference, because of other factors like tax savings and return on investment and so on, it makes a difference of $11,000. And I'm just going to click apply so we can apply that to the plan. Now, I grant you that this isn't very much, but I can recall doing a coaching call a couple of years ago where the advisor called and he said, I want to make sure I'm doing this correctly. And we did a webinar, went through it, everything was correct. And the reason he called was because the plan difference was $500,000. And when we saw it, we thought our way through it. And of course, there was tax savings because of the splitting of the pension income. But more importantly, the husband was about to retire. He had $108,000 a year index pension. And by income splitting, what happened was he got his pension down under the OAS clawback. So he retained all his OAS. And if you figure in round terms, $8,000 a year indexed over, in that case, retirement to life expectancy, I think it was like 35 years. $8,000 indexed over 35 years is a few $100,000. And then you get the tax savings. And then because you have all those savings, you end up earning a higher return on the assets that you have. So all in all, it was very easy to see why there was a $500,000 difference. But the point is, if we were to do that with people, then what ends up happening is they clearly see, I need to, for certain, split pension income in retirement. It's going to make a huge difference. So it's a much more impactful way of learning when we do something with people and they see the consequence of on the plan. Along that same line, I was doing something, a coaching call last week, and the way it worked was this couple who were very tax averse, as everybody is, thought, it would be a great idea if we went in and we did meltdowns where we melted down our RRSP or our RIF early, pay less tax on the money we're taking out. And they were looking at originally an age 71 withdrawal. And we did the regular tax optimization. And again, it said, it'll save you $500,000 if you do all this pension splitting and so on. The husband didn't have much in the way of RSPs, the wife did, et cetera. But then, because they were so concerned about paying as little tax as possible on their RIF income, they said, what we want to do is we want to look at, instead of taking money out at 71, we want to start withdrawing at 62. So we went in, made a change, did the withdrawals at 62, but then we did the tax reoptimization. And what happened was the $500,000 of tax savings was then only $180,000. And, doing the webinar with the advisor, we sort of, said, wow, what a difference. And then what we realized was, of course, that even though they might be saving tax by taking money out early, what they were doing was they were foregoing the whole impact of the compounding of the returns within the RIF. Now, I can show this. It's not going to show much because Bill is 63 already. But if I make a change and say, let's start taking this out at 63, then what's going to happen is that we're going to get a difference out in time, not much, $35,000. But if I then include Sue, where we take money out in her case at 58, this is, take it out longer and so on, then what we're going to get for her is a difference, as you can see here, of about $40,000. So $40,000, $30,000, $70,000 difference. But this is just making a difference of a few years in her case and a couple of years in Bill's case. So in the case where we're talking about taking withdrawals, 9 years earlier for two people, then you get multiple impacts. So it's really very important to be able to do this. And I want to bring this out because the way the advisor was speaking, it was pretty evident that the clients had convinced themselves that taking money out early and paying less tax on it absolutely was the best thing to do. And yet when we went in and looked, what we found was you give up 10 years for two people, 10 years of compounding of the returns, and tax-free compounding is extremely powerful. So what we were able to see was it's not to your advantage to take things out. Even if you pay more tax later, the effect of compounding over time far outweighs that. Now, had he written a plan for the client and his recommendation was don't do that, stay with age 71, I'm pretty certain that based on their preconception, because they convinced themselves this was the right thing to do, take the money out at 62, I'm pretty sure that they would have dismissed that that conclusion that the advisor had. But seeing it for themselves and seeing the difference in that on the tax tab between $500,000 of tax savings and $180,000, I'm pretty sure that they would have reconsidered their thoughts because they would have seen things visually. I can recall years ago working with my doctor, actually, when I was first doing all this work. It's one of my favorite stories. He had been quite ill and had run up $150,000 line of credit at a higher interest rate back then after tax, and he had $250,000 in the bank, relatively low interest rate in pre-tax. So what I said to him was, in one case, you're paying interest with after-tax dollars. In the other case, you're getting, the interest rate is far lower and you're paying tax on the money. So let's look at taking your $250 and paying off that line of credit. So we modeled it. So he ended up with no line of credit, and he ended up with $100,000 in the savings account. And it made a gigantic difference over his life. And he looked at me and he said, I see what you mean. But I'm only comfortable when I have $200,000 in the bank. So let's take some money, pay off half my line of credit, reduce it to $75,000. I'll still have $175,000 in the bank, close enough to 200. I'm comfortable. And let's see the difference that it made. Well, obviously made a difference. But going back to this whole idea of written plans, had I created the plan for the client, that would have been absolutely the number one recommendation, without a shadow of a doubt. And yet, when it comes to implementation, I doubt very much that he would have implemented that plan, or at least that particular recommendation. And many of the other recommendations could easily have flowed through from that first one. So when we create plans for clients, they don't learn experientially, they don't see for themselves, and we're the ones who are really making the decisions for them. And I want to just give you a few lines from a book called The Trusted Advisor. And the author said, expectations that clients have of advisors. 1, help us think things through. It's our decision. 2, don't substitute the advisor's judgment for ours. Give us reasoning to help us think, not just conclusions. Give us options, help us understand, and let us choose. Well, obviously, when we're creating plans for clients, none of that applies. The things that clients most value, most want, are the things that we're just not supplying them with. So that's the whole idea of creating plans for clients. They're proof statements of our recommendations. They take huge amounts of time, and they're frankly not a very effective method for learning. I also want to talk about financial planning tactics and the fact that they're actually outside of clients' control. So when we think about that, the only kinds of things that we can include in plans are the areas of our expertise, meaning tax tactics, portfolio returns, and things like that. The issue is that they're absolutely outside of a client's control. We've seen over the last several years, especially as regards corporations, that governments keep changing the rules all the time. So plans that were built several years ago that relied on certain tax tactics, the plans just don't hold up anymore. Or plans that rely on investment tactics, well, we clearly know that they don't hold up. And so one of the things that I want to do is I want to bring us back when we talk about these concepts to the action equation, which we discussed recently, which is action equals intention plus learning plus belief plus preferences plus confidence. Well, intention is that clear vision of life, but learning is learning by reading a written document. There are all the conclusions. Or learning is learning interactively, where we see for ourselves impactfully what the difference is. The whole idea of the couple that wanted to start withdrawing from the RIF at 62 and 71 instead of 71. Tax savings plan optimization, withdrawing at 71 was 500,000, withdrawing at 62, only 180. The difference being, in effect, the loss of compounding of the money in the RIF. So when we work with clients in an interactive environment, they learn interactively, and it's a much more effective form of learning. When it comes to belief, it's also they see for themselves. There it is. There's the difference. All we did was change the withdrawal age, and immediately we can see the impact. So we don't have to spend a lot of time, writing these lengthy reports and trying to convince people. And the other part of this, and it's very important, is that when we talk about creating a plan for the client and it's based on our areas of expertise, then the performance measurement is actually external to the client. The performance measurement is, to a very great extent, how's my portfolio doing relative to indices, my neighbor next door, and so on. Whereas when we work interactively with clients, the performance measurement is internal. Am I going to achieve the results I want in life based on the things that I can do, not the market? So coming back to this whole idea of plan creation, one of the things that we need to be doing is incorporating into plans things that clients can control. And that includes things like spending and so on. And of course, if we're talking about people that have their own business, like you, generating the wealth you require to have the life you want is to a very great degree based on how successful your business is. So that's internal to you. That has nothing to do with how your RSP performs. It has everything to do with how successful you are as a financial planner or financial advisor. So with many clients, we want to shift that locus of measurement to being something that's internal to the client, so that they can say, yes, I've gotten that result in my business, or, yes, we've been more prudent with the management of our expenses and things like that. They actually have control, and control then is a very important part of confidence. I mean, the reason that clients are doing plans is in fact to be more in control of their life. And yet we base plans on things that are external to clients that they can control. So by taking a more holistic life approach and really, as much as possible, focusing on controllable factors, we're going to increase clients' confidence in their ability to build their plan or achieve their plan. The other thing that I want to talk about when we go back to the reasons that creating plans for clients are just not very effective, and again, it's a time factor, is that when we create a plan for clients, what we're going to do is we're going to show them the financial forecast. This is, the idea of what we did before we changed the vacation expense. And when they see the financial forecast for the first time, obviously they're going to say, well, does that mean? And then they're going to explore lifestyle changes. They're not going to explore, let's buy more critical insurance. They're going to say, can we spend more on vacations? Can we give our children a down payment for their first house? All of those sorts of things. So giving them the financial forecast will immediately lead to things that they might want to reconsider. And if we have to then make notes, go back, add those things into the plan, and then re-meet and re-deliver, then with some clients, as we all know, there could be a number of those meet and revise cycles, again, taking huge amounts of time. Whereas if we're working more interactively, then, we can make the changes live time and cut out all that unnecessary time. And then the final thing that I want to talk about is the whole concept of annual reviews. I think the concept of annual reviews is really, really outdated, because basically what happens is, we have our annual review, we meet with the client, and at that point, frankly, the horse is already bolted from the barn. The client's gone out and done whatever they've done in the last year. They weren't due for a review for, however many months. So they went ahead and they acted anyway. And I think when people act without really a very effective context, what ends up happening is they end up spending half their time looking over their shoulder, worrying whether they made a good choice or not. Whereas if we position what we do as really mastering change, and we acknowledge that change happens when it happens, forget the annual review. Change could be 2 weeks after we deliver or work on a plan with a client, or 2 months, or 2 years. But what we need to do is we need to encourage them, when you're thinking of doing anything of some financial significance, call me. We'll do a webinar, or we'll meet. We'll do a what if scenario. We'll enter what you're thinking of doing, and then you'll see the long-term consequences and make the most informed decisions possible. So we want planning to be, a proactive exercise. And the whole point of this then is by helping clients master change, so that they don't look over their shoulder, so that they feel good about what they're doing, then that's exactly what it takes for us to become, in their minds, their irreplaceable financial guide. Anybody that's using mass market spreadsheet retirement planning tools as totally vulnerable. They're everywhere and they're not hard to use. There's no skill in those. But people that are using tools like VisionWorks, where you're really working with a client, then that you're irreplaceable. Nobody else is going to be able to do that for them. And I just want to repeat that our job is really, when we do a plan with people, the first plan we do with them, yes, it's going to take some time, but that's because we're setting things up for the first time. And once we've done that, we've got a decision-making model that, other than updating portfolio values from time to time, or meeting with clients and obviously putting in the changes that they're thinking of making. But once we've got the model set up, it's very easy to work with in the future. So we've got to look at that initial investment in working with a client really as something that we have to amortize over the time it takes. We have to amortize over our lifetime relationship with people. So those are the things I wanted to talk about today. This whole idea of learning and decision making, part one. Let's look at the traditional learning medium, the written plan, and let's tear it apart. It's just very antiquated.
Book a demo. We'd be happy to show you more of VisionWorks' incredible features.